Let's talk about paid-in-kind securities, okay? And again, I want to mention it not, because there's really no paid-in-kind securities in the actual transaction. But again, if you have it on your resume, it looks impressive. So you can talk about it. People, for some reason, think that if you can model paid-in-kind securities, it's a very complex thing. It's not that complex, especially given the base of knowledge that you know now. So let's talk about it. What is a paid-in-kind security? Yes.
I'm trying to get one right today, Paul.
Okay.
Paid-in-kind security is a debt instrument.
Okay.
That has interest expenses charged in the income statement. However, instead of paying interest, said interest accumulates and the principal amount will increase during the duration of the paid-in-kind security being used.
Very good. You have earned your role of doorman. Right? Yeah. you have earned your role. Yeah, that's exactly right. Or what?
Doorman.
A doorman. So yeah, so it is a security where instead of the interest incurred required to be paid in cash, it is paid in kind, which is some other form. And in this case, you're increasing the debt balance by that interest expense value. So the interest expense incurred, you'll increase the debt balance, you will get interest on that. Now, go ahead.
So the balance on the balance sheet is increased. And just the same.
That's right.
I know we were discussing
whether
you would either split it up and saying, well, we just keep the initial balance on the balance sheet and then add interest payable or something.
I do that.
Payable or something like that.
I do that. I do a separate line. But you know what? I've seen it both ways. It means the same thing.
Yeah, okay. You can do both.
Yeah, you can do both. Yeah. I do it separate just so it's completely clear. Because some people will see just the debt increase line and think, oh, they're raising debt. But no, this is the paid in kind interest incurred. So how do we do it? So I'm going to do it with the notes. So in order to do notes, I'm just going to wipe out this min formula. And actually, I'm just going to put a switch in because I want to keep the min formula active. So I'm going to put a little 1 here. And the 1's going to reflect turning on or off the capability of paying down the notes automatically. We're going to turn it off, and we're going to convert this into a paid-in-kind security. So I'm going to say debt paydown. Okay. 1 equals yes, 0 equals no, etc. And then I'll just multiply this formula by 1, right? The formula multiplied by 1 will give you the result of that formula. The formula multiplied by 0 will return 0 all the time. So it's obviously a quick way to turn on or off the functionality. Okay, so I've run that formula through. I make this 0. And it's not being utilized anymore. Okay. So what I want to do is let's assume that 100% of the interest incurred in the security is PIKed to the balance. Now, most of the time, if you remember the deal that we looked at, the actual transaction, the holdup, they split it up. They'll do, first of all, it'll be very high. It'll be like 15% interest, and 3% is PIKed. 12 is paid in cash. That's the way it usually is. A very small amount is PIKed. But just to show you how it works, let's assume 100% is PIKed. And so how do you think we would do this? Yeah, exactly. We'll add a row.
Saves time.
Saves time. We got a lot to go through. We will have the notes after. No, that didn't come across as rude, did it?
No.
PIK. Thanks. After PIK. So let's just to be completely clear, I'm going to convert this to paid in kind security. Just so we know, these are no longer notes. So I'm going to say paid in kind, and remember the way this debt schedule is set up with the concatenation, I can just turn this into paid in kind security, and it should roll through. Okay, paid in kind security, beginning of year, paid in kind security, end of year, paid in kind security after PIK. Okay, so I'm going to use the same method of concatenation. And let me reword this to make it a little bit more informative. I'm going to say equal to ampersand. Ampersand converts from formula into string of text. No, I don't need to do that yet. Equal to that ampersand. Is that what you said?
Yeah.
Ampersand. I'll use that from now on. After PIK security, after PIK adjustment, PIK interest. End quotes. And no more ampersands. I just want to say ampersand again. Okay. And so the ending balance, there will be a new ending balance, which is the PIK security end of year, of course, plus the interest. The ending balance is going to increase, and I just want to make sure that I am adjusting the formats, right? Got that? And now to make sure that this flows, the beginning of the year balance needs to equal to that new ending balance from the year before. So the interest is now increasing. Before it was 157.5 flat because the 2100 wasn't adjusting. This is going to slowly climb interest on interest. So we will copy this formula to the right. We will copy this formula to the right. And so the balance is increasing. I will save. Yeah? Paid in kind. It's not that complicated. But now this will no longer balance. What must we do? Okay, well, yes. So a couple things. So there is something that we're going to need to discuss and handle. Number one, is PIK interest tax deductible? Because it's not paid in cash.
I would say yes.
It's a debate. You need a tax law. It depends on the jurisdiction where your company's incorporated in. Is it Delaware? Is it this? Every state has different rules. It's really that complicated. Switch. A liability, and we're going to switch it. A switch to liability. Then we'll definitely create a liability. But two things would happen whether you're allowed to get tax deductions on that interest or not. So let's say we don't know. Again, as a good analyst should, you might not know till the very end, till you're in the due diligence phase, so you get a tax lawyer vetting your financials saying, wait, you can't get tax deduction on this, or you can get, and instead of having to go in and say, let me change my model, you'll have a switch to say, no, let's flip the switch 1 or 0, depending on, right? Because you never know what's going to happen. Chances are, you've moved on, someone else is playing with your model, and then they have to say, oh, we have to change the way the PIKs, and it'd be nice if you had a switch that would do that. So we'll talk about that. Before all that, though, let's get this balancing, and then we'll talk about what happens to interest. Okay, so what's missing here?
Seeing the balance sheet.
Mm-hmm.
Well, we're going to have a new
right.
item.
No, it is balancing because the balance is already linked through. But once we link in the interest, it won't be. So let's talk about that. So how does PIK interest flow through all this? Let's draw it out. PIK is tax deductible. Let's say PIK is tax deductible, like interest. What happens to the income statement, cash flow, balance sheet? PIK interest. Yes.
So the interest charge is 10%, or your $10. Taxes are 40, so it's minus 6 for net income.
PIK, tax adjusted, get 4 back. Net income down 6.
The statement of cash flow, we have to add back the 10 you picked.
Okay.
I see you did. You have it already.
6, right?
6, sorry, 6.
Okay, but then you add back the 10.
Okay. Now, where would you add it back?
I think it's appropriate to add it back to cash flow from financing.
Okay. Everybody agree? Why?
Because the principal's getting bigger.
Okay.
So it's like you're raising more capital.
But then you're still saying that interest is an operating expense. To PIK interest.
Well, I didn't view it that way. I viewed it like raising versus paying back down principal.
You could see it both ways. It gets
So would it be preferable to have it in cash flow from operations instead?
No, I agree with you. Yeah, I think it's financing.
Okay.
I just wanted you to think about it because it's a debate. It's actually a debate generally, and I don't think we've spoken about this yet, but why is interest considered operating? It's financing.
Isn't it also depend on the company?
It doesn't depend on the company. What do you mean, with PIK or just interest in general?
The interest.
No, I mean, unless you're talking about banks. Banks are a little bit different. But
Is it because you use the money that you loan for your operation?
that's the theory.
And then the cost.
You can say that about equity.
Yeah.
You know, it's a strange thing. It's debatable. And actually, if anyone work at McKinsey, any consultants, if you'd worked in consulting, they would adjust it. They would remove interest from cash from operating. They would add it back. They would add back interest from your cash from operating, and they would subtract it from the financing activities because to them, it's financing. It's not operations, which makes a lot of sense. But the way GAAP is and the way IFRS is now, they consider interest expense operating.
And what utility does that have for the McKinsey engagement?
You're really honing in on your EBITDA.
Okay.
Right? And to them, interest expense isn't really EBITDA, right? Isn't operations, isn't personnel, isn't revenue generation. It kind of makes sense, I think. And it depends on how you look at it. Right? Because then why isn't dividends operating? You know? Why isn't share distributions operating? Why just interest of all things?
Dividends you can cut off at any time as long as your board says so. You can't really do the same thing with debt.
You can pay it down.
What if you can't though? What if you don't have the cash? Dividends.
All right.
Cash,
How about preferred dividends?
Well, they're more like with debt.
Okay, well then maybe that's where they draw the line.
I just.
Yeah, no, I see your
I
argument.
can't open a door, dude. So.
I see your argument. Give yourself a little credit. So, how does it apply to paid in kind security when you're saying it's financing because yes, it's a loan because it's paid in kind, but at the same time it's interest, and the GAAP sees that as operating. So I've seen it done both ways. I do agree with you though. I put it, at least in the book, I put it as financing. I consider it more financing. Either way, as long as you're adjusting it, I agree with you. So we have to adjust it. So I'll adjust it here. But that's an important debate, and that is a debate that still goes on about why is interest in operating. You know, this is not operations to me. I buy the business. That debt's totally separate. That's financing. That's financing. 10 goes to PIK. What's the cash impact? 4. And how does this impact the balance sheet? Cash goes up by 4. Paid in kind becomes not retained earnings.
It's its own liability.
Yep. 6. That's what I was doing.
Yeah, I was thinking.
And then PIK payable becomes 6. Sorry, 10.
So in a sense, then you could consider PIK as maybe like the kind of deferred tax in a way.
Or not?
It's not deferred tax because it's not the tax adjustment. It's the inverse of that. Yeah. I just consider it like any payable expense, like accounts payable. Yeah, there's a tax implication to it. You still got to pay, or here's a benefit, but the rest of the adjustments have to go through. Okay. How do we do this in the model? So, what do you think? So, the interest expense is already linking through. So we're kind of lucky in that sense, right? It's already being accounted for in our interest. It's already part of this because we're allowing to expense it. What else do we have to do? Balance sheet item, and what else? Cash flow. So let's add a row. Let's put it under, I guess, the notes, because that's where it's coming from. I can maybe change that notes to PIK, but whatever. I'm going to call this paid in kind adjustment, or whatever you want.
And Paul, silly question, but when we're looking at increasing the principal, it'd be the same way as we're increasing the interest. We take the average from the prior year and the current year and multiply it by the percentage, right?
For the principal change?
To understand what the interest would be, and therefore we could add it to our new principal.
Yeah, and that's what it's doing on the debt schedule.
Okay.
It's taking an average of both years. Okay, so it's going to be 0 historically, and then the add back is going to come directly from the debt schedule. Okay? So let Excel work its problems out. Okay? And then here it's just going to be equal in from the debt schedule. This is the PIKed interest 1575, right? Which will accumulate as a loan would. Okay? So you just want to be careful that your totals are still adding up properly. You want to make sure that my total includes everything. Want to make sure that my cash flow before debt pay down includes or excludes that. Keep it out. Yeah. Okay, so we're good. Okay. Now what? Yeah, now we're not balancing. Now we're not balancing. So let's add a row. Now you could have, as I suggested before, we could have just lumped it into the notes, 2100 plus that. I like to separate it. I'm going to call it underneath the notes. I'm going to call it the paid in kind payable. Okay. And it's going to be 0 in the first year, and we're going to accumulate it from the year before plus the balance sheet line item, as always. And we will balance. Zero. Year before plus plus. The balance sheet line item 1575. And it accumulates. Let's make sure it adds up, and it does. And we balance. That's it. Almost. Well, before the switch. Yeah, this isn't balancing. This isn't matching.
Are we including 157 total, what do you say, repayments and
Issuances.
issuance and repayments.
It's an issuance.
I missed it.
Need to adjust that. Okay. The other way to do it is to include it in our cash flow before that pay down.
And that way we can make it. Then it's more or less a mandatory pay now.
Yeah. So you either consider it, I think that's the way I did in the book. It all kind of washes more or less. It's either mandatory up front and then you realize you got to capture it here, or you capture it there and then you don't have to capture it here. It's tough because it's a hybrid, you know? Okay, let's go with it. What else do we have to change though? Something else. We have to incorporate this impact where?
You have an income statement?
Oh, we have an income statement.
Oh, no.
What else? What else? What else?
Do we need to change something in the returns? Or?
Returns. Oh yeah. We added more liability. Got to add the additional term facilities. Yeah.
Oh, yeah.
Less paid in kind. PIK. We got to pull that in. So we got to pull in.
Yeah, if you take the notes from the balance sheet, that would be the same. No.
No, we separated it. You could just copy this line down, except G6 is going to be thrown off, right? Yeah, this reference is going to be thrown off. There you go. I put it in the wrong place, that's why.
So one more down. Okay. That's fine.
Well, I should have done this. And then, and that will impact our IRR. How? Will it impact our IRR? Make sure that links in. Up or down?
Let's stay the same.
Maybe because it's incremental. It should be lower though. More debt. More interest. Interest on interest.
Alright.
Only by the measure of compounding, which is minimal. Because in our case, we're still paying 7.5% interest. It's just 7.5, the little incremental compounding. Okay, what if we decide this should not be tax deductible? How do we do it? What difference does it make? Okay, so let's model out the scenario of the paid-in-kind security being not tax deductible. So the first thing we discussed was in the non-occurring event section, we'd have to add let's do it here. Extraordinary items, we'll say this paid-in-kind security. Okay. And this will be equal to, we'll just link it in directly from the debt schedule, and let's put the switch in. Let's just throw the switch in right here so we can kind of get it all going. So we're going to go over here, we're going to say PIK tax deductible, right? 1 equals yes, 0 equals no. And, you know, obviously, maybe it's not obvious, but I would recommend all these switches and stuff go in one assumptions tab, but for me it's easier to explain on the side so we're not flipping back and forth just for instruction purposes. Okay. So first of all, we need to adjust the interest expense line item, correct? For what? How? It is, but just like what we discussed here, we definitely need to switch it because it's not. It's not what?
That's what I'm saying. Didn't we catch it though? Like it flowed up forward from.
It's caught, but we want to uncatch it.
So you have to actually go down to the bottom where we have it at the bottom there.
Bottom of what?
Of the
That schedule. The schedule you're always talking about. And what do we have to do? So right now we're just linking in from the entire interest line, right?
Then you want to make like 2 line items there, or just because it says we caught from the debt schedule up there? Or do you want to separate the debt schedule and have it?
What do you mean it's already caught?
Because it's flowing from the debt schedule before,
right?
The interest, right?
Right, but we want to be able to toggle it so it's not, right? If it's not tax deductible, we don't want it to be part of it, right? We don't want it to be already caught.
So we have to take it out of our summation formula that we have at the very bottom of the debt schedule where we caught it.
We don't want to take it out of there because you still want it to flow through to your cash flow.
Is the total interest going to expense line?
No, it's in the cash flow from the debt schedule, but Brian was saying to take it out of the debt schedule.
Okay, if
you don't want to do that.
Then what we need to do is add another line item
Mm-hmm.
in there,
Mm-hmm.
and then have it. We have to have it equal to if it does flow 0 times whatever, and if
Yeah.
it doesn't, have it reversed.
What's whatever?
The PIK.
The PIK. Yeah. 0 times the PIK. 1 times the PIK. Okay. So yeah, if you do it on 2 separate line items, I'm going to do it in 1 line item. So I'm going to have equal, instead of equal to the total interest all the time, it's going to be equal to, this is the way I would recommend doing it, but you can do it anyway. Interest on the revolver plus interest on the term loan plus the PIK interest times the switch. So it'll include that or not, depending on the switch, right? Times.
Okay, so it's just there. Okay.
You can separate that into 2 line items, or you just multiply by this. Right? There you go. Oh, that's the, yeah, that's it. Oh, sorry. That also works. You said the same thing except separating that into a separate line item, which is probably better because it makes it more visible to separate into, right? PIK interest and then PIK interest. It's probably better to do it your way, but let's just keep it like this, right? So it's in there, right? If it's 0, we should see that interest go down. So let's make it 0. It goes down, not tax deductible. But it's got to be represented somewhere, so we're going to represent it here. So how are we going to lay it out here? You tell me. Equals. This is the PIK.
Oh, minus switch. So minus PIK times switch.
PIK. I'll keep it positive. I think is still an expense in the way we did this model. The PIK as represented down here. This is where the complexity in the PIK is perceived. 157.5 times, in parentheses, 1 minus a switch. And so there it is. So when it's not up top, it should be down here is the point. Not that it goes anywhere. But this is where we'll represent and flow through. Okay, so tax deductible, yes. Interest expense above grows. This is 0. Tax deductible, no. It's not above. It gets moved down here. Okay? Now what? Not tax deductible. What should we see in the cash flow? It doesn't impact income because it's this 1608 that drives the cash flow statement, right? No. Uh-oh. Why do we do that? Let me see. If I move this up here, it won't impact anything anyway. So I'm going to just change the logic. I'm going to change this to be before the non-recurring events. Okay, that's the way we want. You see what I just did? Okay. I relinked. It was linked down here, and I didn't want it to capture the 1575. These are all zeros, so I'm allowed to do that. Okay. So now if it's tax deductible, that net income will go down from 1609 because the taxes, the PIK is in there. If it's not tax deductible, right? But I want to separate out an adjustment for it so it flows, which we can do it anyway. I'm going to create a line item. I'm going to create a line item for paid in kind adjustment. There it is. It's going to be 0 in the past. Above it's going to be negative to adjust it out. So that effectively when this was linked to, it was doing the same thing, but I want to separate it out so that I can show something that links into other comprehensive income, right? Kind of overkill. I could have just kept it here and then it'll link it to retained earnings. It's still basically doing the same thing, but it's not really retained earnings. It's actually other comprehensive income. See what I'm saying? Either way, it's going from operating into shareholders' equity. So I probably could have saved a big step and kept it the way it was, and I think that's the way it is. But since we brought it up, I think it's important to mention. So we're going to add PIK adjustment. It's 0 all the way through. And actually, it's good to make it explicit. Negative. I want it to be negative. I want it to link from here, not from the debt schedule. So when the switch is switched, it's 0 and the adjustment 0. I don't want this adjustment to be there all the time. Okay? And I just want to make sure that this is totaling properly. Working capital, of course, doesn't include it. Okay, good. Huh, working capital is really minimal. Yeah. Okay, now I just want to make sure this PIK adjustment should still be there. The balance sheet will not balance because we need to link up now in other comprehensive income. It's the year before plus a bunch of stuff, plus that PIK adjustment. Okay, there we go. Okay, cash works. We'll leave it. Oh, and the returns. Fine, right? Still have the PIK. PIK's being built. Looking good. PIK's in there, PIK's in there. So when we switch it, what should change? When we switch the switch, there should not be that PIK below should move up to the interest expense. It should be tax deductible, and it should be that adjustment that we just put in here should be 0. Let's test it out. So PIK deductible, yes, it's tax deductible. Eliminated from the non-recurring events. Net income up, net income down, net income down. That adjustment goes away, and then adjustment goes away. This still stays because we're still deferring it, and the balance sheet still balances. Yeah. That's how you do a PIK. Does anyone have any questions? All right, let's take a break, and then we'll talk about amortizing and capitalizing stuff, especially fees related to debts on transactions. Let's talk about that.